For 30 years, the financial advice drilled into your head is remarkably simple. Max out your traditional 401k, get the employer match, and let compound interest do the heavy lifting in the background. You made a very specific deal with the government decades ago. You took a tax break in your 30s to lower your taxable income, but in exchange, you now share a joint bank account with the Internal Revenue Service. By age 50, most investors have reached their peak earning years. This is a critical inflection point because you are now close enough to retirement to project your future RMDs, yet you still have the 10 to 15-year runway required to execute a multi-year tax conversion strategy. Continuing to follow accumulation rules during the decumulation phase surrenders control of your retirement tax bracket to the government. Under current IRS rules, when you reach age 73 or 75, the government initiates a required minimum distribution, or RMD. The government dictates the exact timeline for these withdrawals. They do not care if you already have enough cash to live on, and they certainly do not care if the stock market happens to be crashing. If you spent decades overfunding your traditional 401k, a massive balance looks great on paper. But in the eyes of the tax code, a massive pre-tax account translates directly into a massive mandatory taxable withdrawal. Pulling out $70,000 or $80,000 in a single forced distribution artificially spikes your income. This frequently pushes diligent savers into a higher tax bracket than they were in when they were actually working. Because the IRS enforces a strict timeline on tax deferral, your 401k ceases to be a flexible growth engine. It becomes a mandatory income generator that you are legally required to draw from, regardless of the market. The strategy for investors over 50 requires a strict pivot. You contribute exactly up to the employer match, secure the guaranteed return, and then stop. Every dollar beyond that match is redirected. This surplus cash is used to create tax diversification, building separate buckets of money with different tax rules to regain control over your future tax rate. This comparison matrix breaks down the tools for that strategy. First is the standard brokerage account. It is funded with dollars that have already been taxed, so it offers zero upfront tax deduction, but it provides supreme accessibility. The primary advantage here is total liquidity. A standard brokerage account has no age restrictions, no required minimum distributions, and zero early withdrawal penalties. This account bridges the gap years. If you want to exit the workforce at 55, you can live off your brokerage account instead of triggering the 10% early withdrawal penalty from your traditional 401k. A standard brokerage account does not lower your tax bill today. It buys timeline freedom, allowing you to step away from the corporate grind on your own terms. The second tool is the Roth IRA, or the Roth option within your 401k. Mechanically, it is the exact inverse of the traditional setup. You absorb the income tax hit today. In exchange, the compounding growth over the next 2 decades, and every dollar you withdraw in retirement is completely tax-free. Our comparison matrix expands to reveal the critical distinction. We add a third column for the Roth and a new row for mandatory distributions. Unlike the traditional 401k, the Roth is entirely exempt from required minimum distributions. Funding a Roth bucket requires careful planning. You have to monitor your contributions so you avoid unintentionally spiking your tax bracket during your peak earning years. Building a Roth bucket is a defensive maneuver. It effectively locks the IRS out of your future compound growth permanently. The third tool is the Health Savings Account, or HSA. While many treat it as a short-term checking account for copays, its real value lies in its long-term investment potential. The matrix updates its final column to show the HSA's unique power in the American tax code. It holds a triple tax advantage. The money goes in tax-free, it grows tax-free in the market, and it comes out tax-free for qualified medical expenses. Wealth managers deploy a specific strategy here. When a medical bill arrives, they pay it out of pocket from their normal checking account. They leave the HSA fully invested in the market to compound over decades. The IRS does not require you to reimburse yourself from the HSA in the same year the medical expense occurred. By saving decades of medical receipts, you can legally pull that money out tax-free much later in life. By age 65, the HSA functions as a tax-free reserve specifically for medical expenses. It provides a dedicated hedge against healthcare inflation in your later years. When the paychecks stop and the decumulation phase begins, drawing income heavily from a single pre-tax account triggers a cascade of unintended financial consequences. A forced 401k RMD immediately spikes your taxable income, pushing you into a higher federal tax bracket. This inflated income then subjects up to 85% of your Social Security to taxation and triggers Medicare surcharges that can triple your monthly premiums. These surcharges and taxes are the mathematical results of holding your entire net worth in a single pre-tax bucket in retirement. Relying solely on a 401k exposes you to sequence of return risk. If you are forced to sell your investments to fund living expenses during a severe market downturn, you permanently liquidate your principal at the bottom. Having liquid brokerage and Roth buckets allows you to skip 401k withdrawals entirely during a crash. You draw untaxed income from your reserves, leaving your traditional assets alone to recover. Tax diversification also protects against the widow's penalty. When one spouse passes away, the surviving partner typically loses one Social Security check, but inherits the full mandatory distribution requirements of the 401k. The surviving spouse is forced to process these massive withdrawals through the compressed single tax brackets, which frequently results in higher effective tax rates on a lower household income. Executing the pivot away from your 401k requires precision. Building your Roth and brokerage buckets demands a methodical 5 to 10-year glide path of strategic conversions to reduce your pre-tax exposure before RMDs begin. Shifting from a basic accumulation strategy to a diversified decumulation plan protects your life's work and your family. Contact our team to run the math and build your custom roadmap today.